Hello, good morning, good afternoon, good evening, depending on where you are in the world. Welcome to the Financial Statement series at the Peterson Institute for International Economics. I'm Nicolas Véron at the Institute, and it's my pleasure today to host Professor Art Wilmarth and Anna Gelpern for a discussion on whether we still have to worry about megabanks, too big to fail financial institutions, and the structure of the financial system, both in the US and internationally. Of course, in the US, this topic, as any reform topic, takes particular resonance given the moment we're in. But we also want to discuss the general underlying principles. Professor Arthur Wilmarth is Professor of Law at George Washington University Law School. He trained at Yale and at Harvard, where he got his JD degree. He went to private practice at Jones Day for 11 years, and in 1986, joined the faculty at DW Law. He has published countless academic publications. He has testified before Congress on numerous occasions. He has been a consultant, in particular, to the Financial Crisis Inquiry Commission in 2010. And he also has a new book, Taming the Megabanks, Why We Need a New Glass-Steagall Act, which was just published, I think, a month ago or so. Anna Gelpern will be our second speaker today. She's the professor of law and the Agnes N. Williams Research Professor at the Georgetown University Law Center. But of course, she's also a non-resident senior fellow at the Peterson Institute for International Economics, with which she has been associated since, I think, 2003. She trained at Princeton and JD at Harvard, like Professor Wilmarth, also a master at the London School of Economics and Political Science. She practiced law at Clary Gottlieb, Steele and Hamilton in New York and London. And in the 90s, she worked at the US Treasury in international policy positions, which gives her also a direct policy experience. Then she was at American University, Rutgers, visiting positions at Harvard, at University of Pennsylvania, and now, of course, at Georgetown. With this, over to you, Art.
Thank you very much, Nicolas, and thanks very much to the Peterson Institute for giving me this opportunity to speak to you this morning. My focus is on universal banks. These are banks that engage not only in traditional banking activities, but also in capital markets activities. My book deals with the role of universal banks in the boom and bust cycles that led to the Great Depression and then to the global financial crisis of 2007-09. And then I discuss the post-crisis reform efforts and why I think those efforts were not sufficient. Why am I against universal banks? I think that they're dangerous because they inevitably promote boom and bust cycles. Why do they do that? Well, universal banks, as you all know, like all banks, take deposits. That's the cheapest money available on the private market for any institution because, of course, it's government supported, government protected, and they convert those deposits into loans like other banks. Well, that itself, I think, is a traditional and appropriate banking activity. But universal banks then go one step further, and then they securitize those loans, create pools of loans, package them into securities, and then spread those securities to investors around the world. Securitization, I think, by banks creates a number of bad incentives. There's this illusion that you're getting risk off your balance sheet, and so you're tempted to take more risk. There are fee incentives that securitization produces upfront fees in large amounts, and the feeling is the fee incentives drive the machine. That was certainly proven during the 1920s when there was a bond craze, both domestically and in foreign bonds. And it was certainly proven during the 2000s with the packaging of very risky home mortgages and other debts into securities. So that universal banking, to me, creates intolerable conflicts of interest. The bank simply cannot act as an impartial lender or as an objective provider of investment advice. It has a salesman's stake in the securities it wants to sell. It has every incentive to keep packaging more loans and and spreading them around. And then universal banks create incentive compensation structures that again promote risk taking. The universal banks have always been dominated by the capital market side of their operation, which is very short term in nature. Let me see if I can pull up a few slides here at this point that might be helpful. Okay, so the first slide I'm talking about shows the great boom, the great debt boom that occurred in the UK and the US after 1987. Interestingly, there were no universal banks in Britain before 1986. The so-called Big Bang reforms allowed universal banking in the UK. And you can see what happened to debt, and this is private sector debt, not government debt. Private sector debt in the UK went from about 60% to about 400% in 20 years. Now, interestingly, if you look at the bottom slide, the bottom panel, this shows two debt booms in the United States. One at the end of the 1920s, which was during the first age of universal banking before Glass-Steagall Act of 1933. And then the second one, again, beginning in the 1980s and accelerating upwards. So you have two peaks, about 250% in the early 1930s and 280% in 2007. Interestingly, Britain had no similar boom during the 1920s because British banks were strictly separated from the capital markets. So, as I say, when you look at these graphs, you begin to see this, what I think almost monotonic association between universal banks and boom and bust cycles. Let's look at global debt. By 2000, there was a group of about 17 very large universal banks on both sides of the Atlantic that dominated our world financial system. And they were pumping out debt of every variety. Obviously, this slide shows the very rapid ascent of debt between 2000 and 2007. It went from 225% of global GDP to 275% of global GDP in just 7 years. Notice that, of course, after the crisis hit, you have a large bump up in government debt. But notice that the other debt aggregates, particularly for financial corporate, non-financial corporate, begin rising again after the worst of the crisis has passed. Now, this graph only goes through 2017. By March of this year, 2020, we were at 331% of global GDP in terms of global debt. Corporate debt has reached an all-time record in the United States, 10.5 trillion. About 2/3 of that is high risk, either junk rated or triple B rated, the lowest investment grade rating. So, you know, we are very leveraged and in a very, I think, a perilous setting. We can come back to this. This is just an indication of the kind of securitization insanity that occurred during the 2000s. And again, shows to me, and we can go into it if people wish to, this almost infernal cycle of continuing to try to securitize, re-securitize, keep pushing risky products into securities that somehow end up getting rated AAA are presented as being not risky. So this pushing of risky debt into not risky securities, but of course they are risky, is part of the securitization problem. This shows how compensation responded to universal banking. Notice that financial compensation compared to other sector compensation was extremely high during the 1920s. And then obviously after Glass-Steagall declined rapidly. And so by the 50s, 60s, 70s, there was almost no difference between financial sector compensation and other sector compensation. Look what happens after Glass-Steagall begins to get torn down, particularly after 1990, just skyrockets. Another interesting fact, the ratio of financial sector CEO pay to senior regulator pay in the US was 10 to 1 in 1980. By 2000, it was 60 to 1. So you see this tremendous disparity between official pay and private sector pay, which has all sorts of problems. The revolving door, at least in my experience, really didn't begin to spin very fast until after 1980, and particularly after 1990. This just shows, again, the rapid increase of corporate debt and how much of it, this is just investment grade debt, but by 2019, half of investment grade debt is in the BBB category, and then you put the junk debt on top of that, and again, it's about 2/3 of current corporate debt. We can get into this later, but if you look at who's owning CLO securities today, and CLOs are highly leveraged debt, the problem is that a lot of those tranches now are being held by insurance companies, mutual and pension funds, depository institutions, bank holding companies. And if we move down to this slide, which shows that you have a lot of these holdings in so-called mezzanine and junior notes, even equity notes, which some people would call toxic trash. But in other words, this debt now is being held by institutions that would have at least explicit or implicit recourse to the federal backstop. Although this trend is probably most pronounced in the U.S., it's almost as strong in Europe. I mean, and in terms of total debt burdens, Europe is probably even worse than the United States. In any case, my argument is that universal banks and their cousins, the shadow banks, create a global doom loop because they have an inevitable propensity to keep pumping out more and more and more debt. Again, if we go back to the global slide, and how have governments and central banks responded? In 2007-09, it didn't happen overnight, but over a period of several months, basically governments and central banks essentially wrapped their arms or their safety nets around the entire financial system, not just banks, and protected the entire capital markets. People argued that problem had been solved by the post-crisis reforms, the G20 reforms as embodied in statutes like Dodd-Frank. I didn't think so. I argued that they had not taken care of the problem because you hadn't changed the structure. Universal banks and shadow banks were still dominating our financial structure. You still had the same structure. What happened in March? Essentially, you had an accelerated version of 2008, where in just a matter of days or weeks, once again, governments and central banks wrapped their arms around the entire capital markets, and this time backstopped the corporate debt markets, because obviously those were the weakest point. Those were going to fail. So now it appears that we've gone from backstopping the entire capital markets to backstopping the real economy. At what point does this cycle become, I think it's already unsustainable, but at what point does it become catastrophic? That's the question I would raise. And at this point, I'll turn it over to Anna.
Thank you very much, Anna.
So it's an honor to be here with Art, who is really the dean of the banking law universe, and who has taught most of us just about all we know, most of us on the law side of financial regulation, all we know about banking. And congratulations on the book and on your continued courage and influence in this space. So I wanted to really pose some questions and see if we could perhaps discuss some of the elements of the problem that haven't yet come up in the presentation. So I think once we put mega banks in the title, we're all sort of on the same page. I don't think anybody likes mega anything unless it's dessert. So from that perspective, right, I do think that it would be helpful, particularly for an international audience, to specify the various possibilities of dealing with mega, right? So there is the size concern and the associated political power concern, right? So if you've got one bank lending to everybody, there are certain political concerns associated with it, no matter how stable and prudent the bank is. There's the separate diversification concern, right? Which is if you've got, and this is your emphasis on universal banks and the combination of banks and securities firms and banking and other activities, which of course is something that's very, that's been very salient in US banking history, but also in different forms elsewhere. I think that the shadow banking problem, which you described as a cousin of the universal banking and mega bank concern, is another distinct area that we should think about, right? So the securitization is in some sense a banking, a bank-like activity, if you will, that presents some of the same vulnerabilities without the same oversight and safety cushion, but it's not, it doesn't have to come from banks, right? So this idea that we've got securitization and risky synthetic complex instruments in the markets is, it stands apart, I think, from both the size and the institutional diversification concern. And I think that's where I would love to get your thoughts on sort of activities-based regulation, right? And to what extent can we think about these issues apart from flesh and blood institutions, if you will, and durable balance sheets. Then another area, and I've got 5, 1 for each of my minutes, Nicola, is this concern about this question of innovation that, of course, is percolating in the fintech space now, and the links between financial technology firms and commercial banks in particular. To what extent can we extrapolate from the experience with Glass-Steagall, right? And how far can we extend Glass-Steagall as a metaphor? To the extent that Glass-Steagall in Section 21, to which you referred, extendable beyond the banking securities divide, payments platforms, right? Service providers, what should their relationship be with insured institutions? And then last, and perhaps closest to my heart, is this question of the doom loop and contingent liabilities, which you mentioned towards the end of your introduction. And in particular, this idea that, look, we used to back banks, but now governments back everything that moves. And the question is, if we get rid of mega banks, to what extent would this change, right? Would we just be backing something else that is not called banks, but perhaps is equally concerning? And then, I know I'm cheating, it's not 6th, it's still 5th. How do we take the solution to the global context, right? So we can certainly try to re-engineer or sort of to change the structure of the financial sector in the United States using some of the familiar tools, be it the Banking Act, the FDIC, or the securities laws, but the structure and path-dependent politics, if you will, of financial institutions, mega banks, diversified conglomerates around the world right, is quite different as the debate about resolution and, single point of entry and multiple points of entry and who insures whom, that debate reveals. How do we, if we change the structure if we break up the mega banks based in the United States, what happens elsewhere? So I'm afraid I just dumped a bunch of questions in this space rather than offer any solutions. Art.
That's great. Thank you, Anna. And indeed, the purpose of this of this whole session is to raise a number of questions and get us out of our comfort zone. So this was superb. I should add that the slides that Art Wilmarth presented are on the Peterson Institute's website, or at least most of them there. So you can come back to them because he had to go quickly on some of the material. Lots of questions from Anna, but Art, I won't give you the floor immediately to answer them because I want to add questions from the floor, and I will add one from Vinay Sharma, which is about the current economics of the business of banking. We have extremely low interest rates. And that changes a lot of equations about how banks conduct their business. That changes the way investors also, I would add, look at bank business models. Indeed, the like fees these days, because you don't get a lot of margin on interest in a number of jurisdictions, including the US. So how is your thinking about structural separation influenced by monetary policy conditions, low interest rates, and the ways that impacts capital allocation? I'll ask both of you to go relatively quickly in your responses, be crisp. We have a lot of issues to cover, but we want to keep that conversational. Art.
Okay, so on the issue of bank size, I think that breaking up universal banks is the easiest and most fair, I think, and enforceable way of limiting bank size. I think size caps are inevitably arbitrary and difficult to justify. And I think that if banks were forced to be banks, and to me a bank should be someone providing deposit taking, payments, lending, fiduciary investment advice type services, I think that my sense is if that's what they were required to do and they were not allowed to become artificially large through adding themselves onto capital markets, commodities, everything else, and becoming too big to fail, I actually think that the size of what I would call a traditional bank would probably be self-limited. I don't think there are economies of scale at huge size. I don't think you'd see $3 trillion banks that were traditional banks. I think they would be self-limited. Shadow banks, I think, are incredibly important because shadow banks, as you've said, are basically quasi or mimic banks. And the way I would first attack them is through shadow deposits. Section 21 of the Glass-Steagall Act, which is still on the books, says that non-banks shall not take deposits. How should we understand deposits? My proposal is that we should understand them to be short-term instruments payable effectively at par or on demand. My proposal would be that no institution other than a bank should be allowed to offer a financial instrument payable in 90 days or less at par in practice. So for me, money market funds, short-term repos, short-term commercial paper under 91 days needs to go in a bank. That would, I think, have a number of salutary effects. You would no longer have shadow banks holding runnable short-term overnight or near overnight money with all the problems that creates. That would shrink shadow banks. If they couldn't offer overnight or near overnight money, they would shrink substantially. If people think, oh, I've got to put 91-day or 120-day money into shadow banks, I can't get it out on demand. I'll have to wait for it, or I'll have to take a big haircut. Suddenly, shadow banks won't be nearly as big, in my opinion. They'll be large, but not nearly as big. And you won't have these sudden payment type freeze-ups. Banks would then have a very secure franchise, and I think monetary policy would suddenly become much more effective. I mean, there have been studies showing that as shadow banks grew, monetary policy lost its effectiveness in both the U.S. and Canada. imagine if all short-term money has to be in banks, reserve requirements would be once again effective and binding, among other things. So I think monetary policy would be much more effective and would no longer have to keep chasing money that's running outside the banking system.
So, Art, we may come back to other questions later. Yes. And again, so this is not intended as a catalog of questions, even so. Sure, Anna asked about. But on this question of low interest rates, I'd like to hear from Anna and how you think about that in terms of the business models.
Well, it's funny that you mentioned this because I was thinking, and I'm sure Art will also have some reactions. I was thinking of the late 1970s and 1980s, right, when the interest rates were skyrocketing, but then the banks were capped in the United States. And I wondered to what extent the low interest environment, and look, I'm not an economist, so I'm not sure that I'm...
We view you as an economist.
Yeah, I'm an ersatz honorary ersatz economist. But
if you're not an economist, I'm not an economist either. So I want you to be an economist.
So look, the question in my mind is, on the one hand, there is pressure for yield. On the other hand, this is an opportunity for fee-based income. So from that perspective, I'm actually not sure which way the low interest rates cut. Right? It very much depends on how you define a bank and what services they can provide that are not. So if you're in a fee-for-service universe, then it might actually be a hedge in this environment. But if not, then then I think you're.
I guess my question is: isn't it the case that you have more opportunities of fee-for-service stuff in capital markets activity and in wholesale activities? Because when you apply big fees in retail banking, generally there's some regulations that takes them away.
Well, right, there's retail banking, but so retail banking is not the only banking.
If you don't constrain shadow banking, then I think inevitably, right, banks will be disintermediated, which is exactly as Anna said, what happened in the 1970s. However, let's do a thought exercise. What if the government had simply forbidden money market funds, had forbidden short-term repos, had forbidden short-term commercial paper, as not existing outside banks? I mean, there was no shadow banking market until about 1980, effectively. Very small. If only banks could provide those services, I think that would make banking a viable entity. I mean, I think the governments have to make a choice. Either you limit what non-banks can do. You don't allow them to do things that I think belong inside carefully regulated, carefully chartered banks. Either you don't allow non-banks to do that, or you will end up, as Anna said, spreading the safety net to include all the non-bank quasi-banks, sort of banks, half banks, because they will be doing bank-type things. I think Anna makes a really good point about the new payments providers. I would say Wirecard kind of provides an example of the new payments provider that ought to, as one journalist said, the failure of Wirecard should be viewed as an Enron moment for the so-called innovative payments industry. I mean, why would we allow a non-bank to be a custodian of people's money, lots of money, and not think that that's going to get us into trouble? Now, I have no problem with a fintech partnering with a bank. So if the fintech wants to provide the service, but the accounts are held at the bank, and the bank is protected, and the bank is responsible for the partnership, I have no problem with that. But when fintechs are basically holding money as custodians and offering bank-like services, but there's no deposit insurance, there are no reserve requirements, there's nothing to protect the customers. When they get big enough and one of them fails, the people are going to run to the government and say, hey, you allowed this institution to exist. You allowed them to create quasi, quantum deposits. Now you have to step in, which of course the government's now stepped in twice with money market funds.
We have a question from Philip Reading, who asked, what is the empirical evidence suggesting that economies of scale are limited? And I will add to this observation from other parts of the world. If you think of China, or for that matter, my own country of citizenship, France, you have very large banks, which are basically traditional banks. I mean, French banks are typically also universal banks. They have a capital markets arm, but that's not why they're large. They're large because of their traditional banking activities. And they're actually huge. They're into trillions in total assets. Yes. So in a way, they're a rebuttal of your previous point. And in China, there are several trillion. So how confident can you be that there is this kind of size self-limiting as you
right? Well, I think that there are 2 points. I think yes, I would expect to see large banks. A $1 trillion bank wouldn't surprise me. I think that it's yet to be seen to me that truly gigantic banks are really efficient on their own. I mean, I think you have to add 2 things. One is if you allow banks to get to a truly giant size, they're going to be too big to fail, whether they're universal or non-universal. And so I think that one has to worry about allowing banks to become that large. The other thing is competition. I mean, competition law doesn't seem to
limiting, right? If that's a dynamic, what you're saying is that regulation should limit the size, but it's not an effect of
Well, I think we should have better competition law. In other words, I think that if we had good competition doctrine, I'm not sure that we would be comfortable ending up with a situation where you only had 3 or even 5 banks in a country as large as the United States. I think China is a unique case because clearly those banks are closely linked to the government and they're arms of the government. But the question would be, if you had really strong competition law, would you really end up with just 3 banks in the United States? But if that were the price of bringing back Glass-Steagall, I think I would probably be willing to pay it, given that I think we would still have a more stable and more resilient and less run-prone system if we just move capital markets out of banks.
But isn't that the key trade-off here? I mean, basically what you're saying is there is no price that's not worth paying for stability. But is that self-evident? Isn't there a case to be made that the efficiency of capital allocation is something that you have to factor in, and that yes, there are trade-offs between efficiency of capital allocation and financial stability, but that doesn't mean that financial stability always win. In other words, you can have a system that is prone to crisis and booms and busts, but over the long term, not just in the good phase of the cycle, brings you better economic outcomes than if you have financial repression across the board. What is your response to that?
Well, I think that, again, if I thought market discipline were really operating, I'm a great fan of the market. I mean, my view of breaking up universal banks is actually to restore market discipline on both the banking side and especially the capital market side. My problem is that we don't have market discipline now. These universal banks and the shadow banks who basically run alongside, they know that there's no market discipline for them because the government will step in and protect them. So you don't see the rise of small specialist firms nearly as much now as you did, say back in the 60s and 70s. One could argue that's technology, but I don't believe it. I think that government support has distorted the market so severely that we almost can't imagine what the market would look like without all these explicit and implicit backstops. So my idea would be, let's go back to where we were and see if, in fact, we might not have a more healthy dynamic. But I agree with you. I'm not in favor of saying, no innovation, no booms. But I just don't want them on the backs of the government, essentially.
Anna?
Well, so I was going to actually pivot a little bit to this question of regulation that you brought up, Nicolas, earlier on in response to the fee-for-service model question, right? You're sort of taking regulation in the background as a given, like whenever you charge fees, there's going to be regulation. But I think that we need to unpack, first of all, regulation is the kind of thing that, that's the sort of stuff we do, we change, right? But then the other piece of it is that you've got to unpack what regulation we're talking about. I think when you're talking about retail and consumer protection dimension, that's so somewhat apart from wholesale and structural, right? And I do think that we need to think about, and depending on what the concern is, what tools we use, right? So if size is a concern, there is nothing that prevents us from using antitrust law side by side with activities regulation, consumer protection regulation, et cetera, et cetera. But the question I'm left with is, how do we, what is the overall package, right? I mean, some of the concerns that I've had with proposals in this space is precisely the siloed character of them, right? So you would have, if the view is that we're going to deal with diversification, and that's where so there's the confluence of, I guess, instability and political power and size and all that, then, then maybe we shouldn't emphasize antitrust as much. But at a certain point, antitrust kicks in because size as such becomes a concern. And I suspect it's different country by country, which again brings me to my nagging worry that we've got different structures that we try to mesh, and that even though supervisory coordination is way ahead of where it might have been, 10 and 20 years ago, I feel like the market is yet ahead of that. So I do wonder how we balance all of these concerns, particularly in the cross-border.
So you mentioned political influence, and that's also an argument, and too big to fail debate, right? This argument has been made by our colleague at the Peterson Institute, Simon Johnson, about, among others, that banks have just become too big because they're politically dominant. And we have a question from Vinay Sharma again: what has been the role of political lobbying in relaxation of regulation for big banks? Goldman Sachs, JP Morgan have played a huge role in running Treasury Department of government in the US. So is this a systemic risk? But then the question becomes, and Anna, you just referred to that, banks deal with money and money talks, right? So is there any way to regulate banks out of that kind of political influence, or is it just a matter of making the political system itself more better protected against influence in general, which is about financing of political life and things like that, but not specifically about financial regulation? Anna, how do you think about that?
Well, so I tend to disagree with some of what Simon had said about and I'm
Simon
not
Johnson.
Still, pardon?
Simon Johnson, I'm just reading.
Yeah, right. So who you just mentioned, sorry about that. But, what I wonder about is whether we should limit this concern to banks. And this is where I do think that antitrust and political reform, frankly, are front and center. So I'm not sure I'm any less concerned about Google or, Amazon than I am about, or, Facebook, that can become, by the way, banking and financial service providers. I'm not sure I'm any less concerned about them than I am about, Goldman Sachs. That said, I think it brings me back to this political economy question, which is, I'm not sure that we can solve this with a targeted bit of structural reform, right, of the Glass-Steagall sort, what you're doing. And there's an old book, Art, you'll remember Helen Garton's Level Playing book, which actually ages ago, but this.
Sorry, what book is that? What is the title?
When deregulation failed, I think, wasn't it?
I think it had Unlevel Playing Field, or
maybe that was it. Yeah.
In the title.
Okay.
But look, I mean, the idea, and it's sort of a read of U.S. financial regulation as a constant adjustment of the playing field, right? But it's it's very much, it looks like a seesaw. There's banks and there's securities firms, and, you know, they're kind of struggling for political power, if you will. And something like Glass-Steagall, you know, creates this tension. You can think of, frankly, the Consumer Financial Protection Bureau as sort of a way of creating a separate power base, right, for consumer financial regulation. You know, that constituency. So I think that it's just more complicated now. So
no, I agree. I mean, I think one virtue of bringing back Glass-Steagall would actually be to create multiple power centers in the financial services industry. It used to be that when the securities, insurance, and banking industries were separated, they were constantly, you know, checking and jockeying against each other. And it really wasn't until the late 90s when they all decided to get together and repeal Gramm-Leach-Bliley that suddenly you had this unified financial industry, you know, kind of megalith or giant that then couldn't be stopped. And so I think if you broke the industries up into separate sectors again, which I think would be useful from a number of respects, but I think, you know, sort of like the idea of having 3 branches of government, you would not have a monolithic giant anymore. They would have their own internal checking and balancing structure. I agree with you. The international stuff is the hardest. I mean, I think there was a moment when, if we had gone toward Glass-Steagall when Britain was going through its exercise, that you know, Britain might have followed our lead. And I still think that the memories of the crisis are strong enough in Britain, you know, and Britain has a much longer tradition of not allowing banks to be in the capital markets. It's only, you know, since 1986 that that's been true. Imagine if US and Britain, you know, agreed on a common Glass-Steagall type reform. I think that would put a lot of pressure on other jurisdictions to think hard about why would we not go in that direction? And I think, of course, the United States and Britain would have to say, you can't come into our jurisdictions and carry on business the way we wouldn't allow our own banks to do.
Well, I don't want to open the Brexit box because that would be for a different session. But what do you make of the Anna's point about big tech, right? I mean, we have Facebook and, you know, Google and whatever. And we're at the time of the IPO of Ant Financial, which is so far the most advanced example of a big tech firm, Alibaba, entering the financial space. Even so, Ant and Alibaba are separate companies, but they have a common shareholders and many other links. So isn't your fight on Glass-Steagall in a way yesterday's question, because tomorrow's question is an even bigger concentration of power with data aggregation capacities between big tech and big finance? How do you think about that?
Yeah, so I agree with both of you that I think big tech is just as frightening and currently perhaps more frightening than big finance. Although I think big finance still holds a lot of the important reins. The last thing I'd want to see is something like an Ant Financial or a Tencent taking root in Western countries, and even in China, it seems like now they're reining them back because they're discovering how powerful they've become, and they're worried about it. But this raises a whole issue of separation of banking and commerce. So my view is absolutely we have to keep banking and commerce separate. But I don't think we can do that. I don't think it's viable to keep it separate in a long term unless we go back to a Glass-Steagall approach where banking was really special and confined. I think once you allow universal banking, the pressures to break down banking and commerce are irresistible. And I think we're seeing that, you know, play out now. So this takes me back to my payments point. I have no problem with any fintech offering payment services, but not if they're essentially holding deposits, right? If they want to partner with a custodian bank and the bank takes the responsibility. But I think once you allow fintechs to basically hold shadow deposits, then I think the game is over.
Anna?
So I wanted to follow up on that because I'm still struggling with decision making, right? So sort of the way I think of the shadow banking problem and kind of the problem in the space is in two parts. Who makes the decisions and where's the balance sheet, right? So to the extent that you've got the bank balance sheet, but then the decision-making is in the fintech underwriting model, right? I wonder to what extent this sort of a combination is supervisable and to what extent we're able, so it's not just about whether we can, figure out the algorithm, but also about whether we can kind of reach the human agent behind it.
Right.
And I think that is a huge
Anna. Yeah, I want Anna to finish her thought.
I was just waving my arms.
Very briefly, and we'll move on to another question.
So I think that right. In my view, it would have to be a proper, contract-based partnership where neither side was exercising a controlling influence over the other. The minute you have control running from banks to fintechs or control running from fintechs to banks, then, as you say, the line has been breached.
But isn't any partnership unbalanced? And also, how do you distinguish? There's a question from Catherine Lynch. How do you distinguish between processing payments and taking deposits? What exactly would be your criterion for that?
Yeah, so my view would be that the fintech could provide the service of taking the money out of account A and bank here and moving it, let's say, to another bank, or if it's another country that doesn't have those type of regulations, wherever the recipient is. But in other words, the fintech takes the money out of the account in bank A and transfers it. But the fintech is not holding that money, obviously, other than momentarily. It's not a custodian of the money. So
it would be just a time limit for the
my view would be if one can always split hairs, but if it was less than 24 hours, let's say, something like that, given how fast payments are going now, I can't imagine it would take more than 24 hours. So I think I'm not hyper technical to the point of being unrealistic, but I think once the fintech is holding that money, I think for more than 24 hours, let's say, if we as a thought experiment, then it begins to look like a custodian. And to me, once you're a custodian, you're essentially a deposit taker.
Okay. I want to move to a slightly different set of considerations. We have a question from Bill Cohen, who, of course, was Secretary General of the Basel Committee for several years, and he makes a case, as you might expect, that there have been a bunch of reforms since the period that your book described as the last crisis in the book, right? I mean,
chapter 12 is all about that.
There's been dramatic changes in global standards, risk retention rules, capital charges, especially for structures like CDO squared, better supervisory oversight, revamped disclosure. I'm quoting Bill Cohen here: rating agencies reform, less reliance on ratings, better governance, risk management. So essentially, aren't you chasing the last crisis, I guess, is the question. And in a way, the COVID episode goes, at least on the face of it, in the same direction, because we have heard a lot about, banks not being the problem this time. And yes, you mentioned that there was a bailout, if you want to call it that way, of the market in mid-March, but that precisely was not about banks. So it's a question of where the risk now is, and partly on the face of it, I'm not buying it, but that's a separate question. Not in the banking universe. So what do you make of all those reforms of the past 10 years, and are you not discounting them?
I think that one could say that they were better than what came before. Now, to me, that isn't, and I'm in no way trying to depreciate all the hard work that has gone into the reform efforts. But essentially, in 2007, we had a woeful system that was horribly undercapitalized and horribly supervised and ready to fall. I think the system is more resilient now, but I think most people would say that the capital levels we have are nowhere near where they should be if you really wanted a resilient system that wouldn't require repeated bailouts.
But didn't COVID exactly prove the opposite? I mean, didn't we see the banks having enough capital to withstand a massive shock that was completely unexpected without having to panic and be recapitalized by the government?
Well, no, I think that was never put to the test. I mean, markets were freezing up in both here and in Europe in March. My strong impression
My question is about banks.
Yes. But if the government had not rushed in and essentially bailed out the money market funds, bailed out the commercial paper market, bailed out the corporate debt market, a lot of, particularly the corporate debt, as you look at those slides on who's holding CLO tranches, a lot of that debt would have come crashing down back on the banks. I don't think the banks necessarily would have been able to withstand what happened in March. If the fact that the governments and central banks rushed in literally overnight, to me indicates that the entire system was under immense stress, and that banks would not have been able to survive if they hadn't done what they had done. So
Anna, how do you read that episode?
Well, so I was actually, I mean, I'm struggling with it because I feel like the implication is that even if we didn't have megabanks, we would be bailing out some of these debt markets for their own sake, right? So it's a little bit, I mean, there's a bit of a chicken and egg question here, whether these markets were bailed out for the sake of the banks, or whether the banks were, bailed out in 2009 for the sake of the real economy, which of course is the kind of the story. So, I mean, this is where I think I struggle with a lot of the narrow bank proposals, right? Which is that, and some of my most beloved colleagues have made those, right? Long time. But like, fine, you can make a very safe piggy bank and call it a bank and have a whole bunch of risk elsewhere. But to the extent, and this again takes us, to different countries which organize themselves differently, right. To the extent there's a part of the economy that you care about, whether you're the United States, France or China, you're probably going to bail that part out. I think you're right, of course, that the banks are a particularly vulnerable vehicle. And to the extent this is if the banks are the principal kind of nexus of money creation, then whoever you bail out, you're going to bail out the banks.
How do you, Anna, look at, Anna, how do you look at Bill Cohen's question, right? I mean, Basel III also of the last 10 years. What's your assessment of how it has changed this whole debate?
Well, I also looked at Ted Truman's question that
right.
At the top of it, right, which is, it was a question about whether the Volcker Rule, which is really the structural regulation piece of it, and its various cousins, in the UK and in Europe, whether how important did they prove to be in the grand scheme of post 08-09 reforms, right? So is it the just overall increase in the capital cushions? Is it the focus on liquidity, which I think actually it really bears a lot more emphasis? Or is it what structural safeguards, if any, we were able to impose, right? And I think that the clearest answer is there's more capital and there's more liquidity, and you can debate about what that means, having more liquidity in institutions, what that means for market liquidity. We can sort of talk about that, but I think everything else is a bit of a question. I think there's progress on coordination and supervision, although there's some backsliding quite a bit. And
the US, you mean?
But I'm not sure that, I think the clearest bit of progress is capital levels.
I think one problem is that the capital levels basically have stopped rising. They stopped rising in 2016 and they've slid back a little bit. I mean, I think there's not been much, right? There's been almost no progress on capital since the beginning of 2017. I would say about Volcker Rule, why did the banks work so hard first to weaken the original rule and then to weaken it further at the most revision? They must think it binds them because they worked hard to weaken that rule. Why did they work so hard to repeal the Lincoln Amendment, which says they can't do swaps inside banks? So to me, you know, if the industry is spending so much time attacking the Volcker Rule and getting rid of the Lincoln Amendment on swaps, that indicates to me that this idea of the deposits subsidizing the capital markets is absolutely the crucial story that we have to focus on. They wouldn't be spending so much time and so much money if these things weren't troublesome to them. The last thing I would say is, because I think this kind of gets the nub of it, if you did what I propose, my bottom line is you'd have a lot less debt creation. You couldn't keep churning out these horrible amounts of debt, which make our system completely unsustainable, unstable.
So we have a question which I think is sorry to interrupt. We have a question which I think is very thought-provoking by Barbara Harper on how the genius of Glass-Steagall, as she puts it, was to create a division of labor into regulatory structure. So the SEC was focused on market integrity, the banking regulators on safety and soundness, including concentration, to the extent that concentration is part of safety and soundness. And I'd be very interested because we're getting closer to the end, to have both of your thinking of supervisory architecture and how supervisory architecture could participate in this, you know, bringing the system to a less unstable behavior, as we've discussed. Art.
Well, I think that's a very good point. I mean, it kind of mirrors the point of saying if you break the industry into three sectors, they will check and balance each other. I think if you break regulation into different specialties, they're likely to be better at it. I mean, how well did the FSA operate before it was basically put out of its existence in 2007? Not very well. I mean, a lot of people thought that having one big umbrella supervisor was the be all and end all. It didn't work well. I think that we have to accept that there's a limit to the human ability to manage things and supervise things. And the idea that the bigger is always better or that more is always better, I think it's been disproven, in my opinion.
Anna?
So I do think actually that's a genius question. And I think it's, and I don't think there's a simple answer to it. I've struggled for the longest time to figure out how it is that in the UK, they're able to sort of overhaul the supervisory apparatus, you know, twice when we're not even able to sort of figure out SEC and CFTC, right?
Yes, that would make sense, combining those two.
Right, between the commodities and, you know, derivatives and securities regulation. So I think that the way in which different systems approach these questions, I think, is super interesting and somewhat puzzling. But I tell you, I've been really preoccupied with this question of SEC capacity and interest in financial stability regulation, right? And that, I think, is actually the downside of separation, maybe, or maybe you would have an incentive to develop financial stability competence, if you will, or an interest in financial stability regulation in the SEC, because part of the problem we've had, I think, and the still unresolved, I think, is this question of bank-like risk in the capital markets, which I don't think we can eliminate for all the structural reforms. We can reduce it, but I think that it's still there. And if you've got a regulator that whose mandate is investor protection, right, and market integrity. So basically, so long as you push all the information out into the markets and nobody is cheating and everybody is a consenting adult, that's it. Nothing bad can happen. And I think that if anything, we've learned that that's not quite right. And so how you get a securities regulator to worry about financial stability in a bank-like way is a supervisory architecture question. And
also, how do you avoid it becoming a competition for turf with the Fed, right? Because the Fed, in the US context, will always think it has a responsibility for the system as a whole and not just the banking sector, even though it's very bank focused by its very nature.
Absolutely. Yep.
I mean, ideally, of course, that's what FSOC was supposed to try to mediate. And I actually like the idea of FSOC.
Financial Oversight Council, which is chaired by the US Treasury Department.
Yes, I think that, these are all imperfect compromises, but I like the idea of specialization, but I also like the idea that there is a check and balance. And I think if FSOC were actually functioning effectively, I think it could serve that purpose.
So we've covered a lot of ground, and there's more ground to cover. There is a question by Michael Smith, who is based in London, who asked whether there is evidence that the Biden presidency and Democratic House would pass the legislation needed to rein in the universal or mega banks. We're not going to answer that question today, if only because the election has not yet been completed, and the result is anybody's guess, I think, at this point. But I want to thank very warmly both Arthur Wilmarth and Anna Gelpern for what I thought was a very stimulating discussion about issues that are quite fundamental in a lot of the questions we're all asking ourselves about how to make the financial system less dysfunctional. Our next session after the US election will be on November 9. I will host Andrea Henry as the chair of the supervisory board of the European Central Bank, because it will be the 6th-year anniversary of European banking supervision in the single supervisory mechanism. And we'll discuss that also with Tam Bayumi, who recently was at the IMF and also a former visiting fellow at the Peterson Institute. Anna Gelpern had to leave us because she has to teach her students, which has priority, but in her absence, I want still to thank her very warmly, thank Professor Wilmarth for an extremely thought-provoking conversation, and wish you all a very good rest of